energy, gold. Like I said, gold, all you have to know about gold, it's simple. Where are real interest rates going? They've peaked, they're going to be coming down. And where's the US dollar going to be going? Well, because the Fed is going to be going on pause and cutting interest rates ahead of the ECB and ahead of the Bank of England, that's all you have to know about relative interest rate differentials are going to work against the US dollar. Gold is priced in US dollars. Gold and energy, and of course the Canadian banks are at levels that in the past you wanted to buy at these levels. They're very cheap. And, look, there's always risks, but, the dividend growth and the dividend yield in the Canadian banks, very alluring. The overall market itself, and the part of it is, as you said, the composition. Where are you going to get a 13 multiple in a liquid part of the market? And you don't have to go to the Wild West. I know emerging markets always have this sex appeal, but they're inherently volatile markets as well. For Americans in particular, we're right next door, speak the same language. And I'm saying basically, I would just come in just by the TSX. Two standard deviation events, a 13 multiple against a 19 multiple. Everything in Canada, market-wise, economy-wise, we're 95% correlated with the United States, Canadians. We've got this wide divide now in terms of what is the earnings yield in Canada against the earnings yield in the United States is such a gaping hole. So actually, and this is coming from the renowned perma-bear David Rosenberg, I'm actually bullish on the Canadian market because it's priced for my bearish macro view. That's fine. If the US market was priced for my bearish macro view and it was trading at a 13 multiple, I'd probably be saying enough is enough. We never got remotely close to there, and now we're almost at a 20 multiple in the US. So There are places to put your money to work. But yeah, Canada right now looks very compelling to me. Especially, and look, you can put together a trade where if you're just outright bearish completely, you can just put on hedges where you basically just short the U.S. market, go long the Canadian market, and play that spread. You could do that too. So, but the Canadian market, I think, and that way, look, you're long the Canadian market, but it's not going to go down. And if you go to another global bear market, the Canadian market will not go down as much as the U.S. market will. So that's the way that I look at the situation is relative valuation, and then when you hit two sigma events, that's an eye-opener. All the population growth in Canada, and it's significant, is all coming through immigration. And what makes immigration different than natural population growth is that these people form themselves in households right away, either renters or homeowners. And you're right, that's putting a lot of stress into a national housing market that was already supply constrained. So you got the situation where it's crazy, where you look at home prices relative to rents or home prices relative to incomes, affordability. I mean, if we had to mean revert the affordability ratio in Canada, if home prices were to be the factor to equilibrate it, we would have to have house prices go down 25%. That's how crazy it is. And look, we all know it's become a major social problem. We just had a new mayor elected in Toronto, and the whole thing is, please, find a way to ease these upward pressure on prices. And you're right, it's striking. I don't think I've ever seen this before. By the time John Crow, it's funny, nobody knows who John Crow is. That's all we talked about back in the late 1980s. He was Canada's Paul Volcker equivalent. By the time he raised rates, like Tiff Macklem has done, it was like sayonara, or I should say au revoir, to the Canadian housing bubble back then. Remember, we had a big bubble in the Canadian housing market, especially in South Central Ontario back in the late 1980s. And here we've got the Bank of Canada's raised rates the most since John Crow of the late 1980s, and the housing prices are just continuing to roll right along. It's incredible. And I think you're probably right. I think this is one of the dark sides of having this benevolent and aggressive immigration policy, is that it's exacerbating this housing bubble in Canada. And people don't like when I use the words bubble, but once again, when I see something that's a two standard deviation event, when I see that home prices are so out of whack with incomes, but yeah, it's been very. I'm stunned. I'm stunned that house prices have not been more responsive to what the Bank of Canada has done, and I'm sure that the Bank of Canada is equally frustrated. I think there's only one way that you solve the crisis, and I'm saying this even though if I was at the Bank of Canada, I would have been classified as a dove. I don't know if I'm such a dove anymore. I think that there is a way. If CMHC is not going to step in and or finance department and start to constrain the availability of credit through amortization or loan to value requirements or moral suasion with the banks in terms of credit availability. Because housing ultimately, unless you're just talking about all cash deals, but that's a small percentage. Well, you either constrain the availability of credit for this inherently credit sensitive sector, or you raise the cost of credit. And I think what's going to happen, I think the Bank of Canada now, it's like damn the torpedoes, full steam ahead. I'm stunned at how hawkish they've become. And there's going to be an interest rate that is going to really break the back of this thing. So it will do it two ways. So it will be an interest rate that really makes it really hard to make that decision to buy a home in Vancouver or Toronto or anywhere else. And on top of that, there will be an interest rate that creates the conditions for an economic recession, which means what? It means employment loss and higher unemployment and reduced incomes. And then what happens is you have a sharp reduction in housing demand. So even if you have a very inelastic supply, the demand curve will take over. So I'm starting to think that, maybe short-term rates go up a lot more. That's what I'm saying about your friend just locking in 5 years right now. The way these central banks are talking, by the fall, rates could be up another 75 basis points. So I said, keep the powder dry for the stock market. You might get a better chance to roll into shorter-term treasury bills 3 months from now. But yeah, I'd say if I was a central banker, and you have to have, if you're going to create the conditions for lower inflation in the consumer sector, which is what they want, this 2% holy grail, well, guess what? Asset inflation has to play a role here too. Assets, that's basically equities. And I'm saying that basically they say don't fight the Fed. I don't think the Fed's too happy with the stock market going where it's going. That's why this is going to be short-lived. This is not 2020 when Jay Powell wanted the stock market to go up. This is not what they want. They need to have financial conditions tightened. They need, I'm trying to say, people won't like this, to get the consumer disinflation they want, they're going to have asset deflation play a role. Well, by the way, the two assets we're talking about here are the two assets that are still spiraling upwards, which is residential real estate and equities. So that leads me to a belief that, these central banks might not be close to being done. I think there's something to be said about an event that happened in the past year, which was how the administration unilaterally decided to freeze those Russian reserve assets. And all of a sudden, you've got these different trading blocks taking place. Maybe it's between Brussels, Brazil, Saudi Arabia, Russia, India, trading oil and in renminbi, or, so these little new blocks of currency blocks that are propping up, and you're noticing that the share of dollars and global reserves is going down. And all you have to know is that if you're bearish on the US dollar, and there's reasons to be bearish on the US dollar, and there's reasons to think that maybe in our lifetime, that the US dollar, maybe it will not be the reserve currency. I'm not saying that, I'm throwing it out there because historians are going to be looking at that decision by the White House as a possible inflection point. Just like in 1971, when the Nixon administration closed the gold window, nobody really knew what the long-term effects are going to be, but it had all sorts of perverse effects. And I think that this is going to exacerbate the decline of the US dollar in the global trade and payments system and in reserves. That's all I need to know. Bearish on the US dollar, and we're at peak interest rates. Maybe not right at the peak, but getting close. And those are the two most powerful correlations, really, is real interest rates, which I think have peaked, going to come down, and the US dollar, which has peaked and is already in the early stages of a bear market. That's all you need to know to be bullish on gold. My latest portfolio move was buying 3-month paper and gold coins. Gold coins in Ottawa, stored at the vault. From the Canadian Royal Mint. The beautiful gold coins. Of course, there's a premium, but when you sell them, you'll get the premium. But that's, and I'm continuing to buy gold coins.